Okay, welcome back, everybody. Congratulations. We made it to the best panel of the day. Bank FinTech Partnerships, also known as couples therapy for the financial sector. Seriously, like that's a pretty apt metaphor if anyone's been tracking this for as long as I've been in it, or folks in this room have been in this space for a long time. It's not too long ago we remember the headline that FinTechs are going to replace banks or displace banks. And over the last few years, what we've seen is actually something much more interesting, an evolution of the relationship. FinTechs have deepened their relationships with legacy institutions, both in complexity and the product suite. Some have decided to navigate the process to become banks themselves. So we've seen quite a shift, and we're going to lock in and focus and unpack all of that with this esteemed panel and help us piece this all together, figure out how we got here, where we are, and where we're going. So we're going to start off with a quick to our esteemed colleagues, intros down the line, and then we'll just jump right in.
Hi, my name is Penny Lee. I'm the president and CEO of the Financial Technology Association. We are a trade association in Washington, D.C., representing several large or multiple types of fintech companies. We are on the non-crypto side of the ledger, as I like to say. So those that are in the traditional finance. So hopefully a lot of the folks that are on your phone and that you use every day are the members in which we work with. And also thank you, Jalapa, for inviting us here today.
Hi, everyone. I am Heather Holding. I am the Chief Risk Officer at FinTech. We are a fintech company that specializes in consumer loans. We're here right in Wilmington. And I'm very excited to be here. And we're actually in the process of getting acquired by Barclays, which will be really relevant to today's conversation. Go ahead, Lindsay.
Hi, I'm Lindsay. I'm the EVP of Banking at Sphere Labs. We're also registered in Delaware, but we're in Dover, Delaware. Sphere is partly a stablecoin orchestration platform, so companies come to us if they want to do cross-border payments using stablecoins, and we make it very easy for them. And then we're also partly a permissioned blockchain with privacy options. Prior to this role, I used to be the Senior Director of Financial Partnerships for Circle, building out our global banking network. And then prior to that role, I was the on and off ramps partnerships lead for Facebook's Calibra.
Great. And moderating and hopefully shepherding this awesome discussion, I'm Scott Estrada. I'm the Policy Director at Affirm Inc. Before somebody would ask, yeah, but what firm? It's Affirm, buy now, pay later. That joke is seen as use, yeah. But so let's jump in. Penny, I'd love to start with you. Leading the FTA, kind of making sense of this shift from banks displacing fintech to now banks, or fintech displacing banks to fintechs becoming banks. What was the inflection point there, and what drove that trend from what you're seeing, and what options has that created for your members now that they're either considering or in the process of?
Sure. So we launched FTA 5 years ago, and at the time it was 2021, coming out of the pandemic. There was obviously coming out of the Trump 1 administration into the Biden administration. And at the time, we had two member companies that had charter applications, one in the FDIC and one at the OCC. It was quickly understood that those were not going to go anywhere anytime soon and were eventually withdrawn. We had initial conversations with the OCC about potential ability to be chartered entities, and we're told in that meeting that fintechs just don't have the right culture to be able to become a bank. And so that was 2021. Fast forward to where we are now. During that time, what you did see was the incredible innovation that was occurring was through bank fintech partnerships. So partnering with community banks, partnering with other large regional banks or others to be able to offer innovation to consumers, small business, kind of disrupt certain type of industries or offer a different product and that was done through a traditional bank fintech partnership. Fast forward to today, in 2025, you had 14, I believe 14 charter entities become chartered. Today you have 18. In 2026, you have about 18, I know, fintech companies that are looking to be chartered, and they're chartered in different ways, seeking a full national bank charter at the OCC, a national trust charter, an FDI or an ILC through the FDIC, potentially purchasing a state bank, all over that path. And I think there's a couple of different reasons for it. One, and I will say that also, not everybody wants to be a depository taking institution. So you still have, to your global ecosystem, you still have an incredible robust bank fintech partnership. As far as us taking over the banks, I think we are having, going into certain market shares, but you also have the 6 largest GSIBs have their most record year ever. So there's still a very robust banking system in the United States. But what you are seeing is this innovation taking hold, and some are choosing for chartered entities and some are remaining in a bank fintech partnership. I think some of the reasons for the wanting to seek a charter is these business models change, and what they might have been perhaps just solving one issue, whether it be whether it be a certain type of just one product, say like a BNPL, they might now be doing investment advising, or they might be doing capturing your deposits, or they might be doing P2P. So they themselves are changing, and with that change, needing more of a structure and wanting to own their own infrastructure. At the same time, you've also seen rates go up, cost of capital is more expensive. And so they're wanting to seek and be able to reduce the cost. Also, it allows them to make a payment faster and cheaper as well, if they can do it on their own rails. So kind of a host of different things, but it's also an atmosphere that is allowing for these charters to take place. And that openness that had been stopped for about 4 or 5 years has just radically changed who is seeking, why they're seeking it, what they want to achieve from it.
Thank you, Penny. That's actually a perfect segue. Heather, I'd love to get your take on the inside of this shift from displacing to partnering, and how much of it can be explained by economics, the macro trend, or is there something more existential here about surviving in such a rapidly changing
Yeah, absolutely. One interesting fact is large fintechs typically spend about $50 million to $100 million a year on these fintech partnerships. That is a ton of money. And the challenge with that is, you have very complex processes. You have to have warehouses. You have to be heavily invested in capital markets. You have to have strong regulatory overhead. But the one thing that is really the downside of all that too, on top of it, is you don't have control. So your partner bank really sets your credit policies, how you manage risk, how you manage compliance, how you actually grow your organization. So that's one of the reasons why a lot of fintechs are looking to potentially get their own charter so they can control their own destiny and their products and the services that they offer. But as well, like just over the past couple of years, the regulatory landscape has really changed. Probably about two years or so ago, probably about 30% of sponsor banks were under a consent order. And that really changed the landscape for fintechs and really pushed those requirements on fintechs to actually operate their risk and compliance functions more like a bank. So if you're acting like a bank and you're spending all this money, like why not become a bank or be acquired by a bank or by a bank? And that's what we're really seeing in the industry right now.
Great, thank you, Heather. And Lindsay, if traditional partnerships are so complex, you're at expert level with stablecoins. So can you just walk us through or give us your take on what these partnerships actually look like, what they're doing right, and what obstacles or opportunities are when you're talking about the intersection of stable coins, banking, and fintech and currency. You're right in the middle of it.
Sure. So I'll start by defining what we mean by on and off ramps. So when a customer gives us fiat and then we give them back a stablecoin, that's on ramping. They're on ramping on the stablecoin. If the customer gives us stablecoin and then we give them back fiat, that's off ramping. So on and off ramping almost always uses an existing rail like RTP, wires, ACH, and that's kind of the role that the bank plays in that process. So now I'll talk about the most common types of bank fintech. The most common types of bank stablecoin startup partnerships that I see, and then the types of partnerships that I hope to see in the future. So the most common types of bank stablecoin startup partnerships I see are the bank provides corporate banking to the startup. That's the most basic type. The bank holds the reserves if the startup is a stablecoin issuer. The bank is a custody holder, a custodian, if the bank has the licenses to be able to hold digital assets, or the bank offers on and off ramps to the stablecoin startup. So in that kind of partnership, the stablecoin startup provides the customers and then the technology. The bank provides their license and their payment rails. And together, they enable on and off ramping on stablecoins. So those are the most commonly seen types of partnerships. Now, the more advanced types of partnerships that I hope to see are perhaps in the future, we might see banks as validators in private blockchains. So that would be one type of partnership. Or idealistically, I hope that banks and startups can work together to unlock the capabilities of stablecoins. Because currently we are at the very elementary level of using stablecoins. We're just using them for cross-border payments, or that's what we often talk about. We're using them for retail payments and cross-border payments, but we don't really talk as much about using them as programmable money, using their smart contracts capabilities. So I'm hoping that in the future, banks and stablecoin startups can make that reality. So for instance, maybe there's an influencer and then they have a lot of followers. It's really expensive for the influencer's followers to give that influencer $1 each, but that's possible with stablecoins. And maybe that crowdfunding can be triggered by a certain incident, a certain event. So that's possible through smart contracts. Or maybe we could crowdfund insurance. Let's say everybody pitches in a small amount, and then if a catastrophe happens, automatically the smart contract disperses that funds to the beneficiaries. So hopefully banks and financial institutions, regulated financial institutions can work with startups to make that possible.
Thank you, Lindsay. So I want to use the back half of this discussion. So now we've kind of had a good overview and inside view and frontier view of these models of the regulatory plumbing around this, because it doesn't obviously exist in a vacuum. So, Randy, I'll start with you again. I know that the Fed has recently proposed there's skinny master accounts. Love to get your sense if this is something that's helpful for your members, if it's a stepping stone or missed the mark. And if not, what are some of the things you think should be talked about or you're excited about, or conversely keeping you up at night?
You know, we appreciate the Fed having the conversation and putting the proposal, the payments prototype proposal out there for comment and for consideration. It is a step forward to even have the consideration of a different way or a different type of access into the Fed services. There are some gating issues for us as FinTech companies that would say, make it less attractive. Right now, you still would have to be a depository institution, which means you still have to go and get a charter. So there is a lot of non-bank payment companies that are moving billions on a daily basis that are just simply almost moving the credentials to the payer and payee that do not want to be custodians of money in the sense that they don't want to be depository taking. So that limits kind of the adoption from some of our members because of that gating issue. Second, also, it limits the ability, if you were to become depository taking, it prevents access into Fed ACH, which that is the bulk of the volume, 80% of the volume, especially on the payments, is on that particular rail. So that one, and these are comments that we have given the Fed and seek to work out. And I know they're still through an open rulemaking. So these are some of the concerns that we have raised in our comment letter. There's a couple of other ones as well. But the main one is also, as you have the 3 tiers, tier 1, 2, and 3, we do not want this to be limiting, meaning those that are in a tier 2 or in a tier 3, that the previous rules allowed them to ask for or to apply for a full master account, that this isn't the default. That now full access would not be granted and only a quote unquote skinny master would be their only avenue. So those two, a couple of things in and around it, still want to work to, the rulemaking is still open. I think Governor Waller said, in the press, he had a lot of comment letters on this proposal. I wish everybody would stop yelling at me. We're not yelling. We want to be as constructive as possible, but there are limitations, and we also understand there's statutory limitations. And so there is potentially, it could be coming out soon, a proposal coming out of Congress to allow non-bank access into Fed services through a different criteria or through a different realm. This is done in the UK, Singapore, most jurisdictions allowing certain type of payment companies to have certain type of access to the Fed rails. Again, faster, cheaper settlement rates, as we've heard all day today, 24/7, 365, especially on a cross-border and other things. To be able to settle that cheaper and faster is what our goal is.
Thank you, Penny. Lindsay, does this move the needle for you in your industry? And if not, what's on the front of your radar? And feel free to expand as we've talked about the changing political or policy or regulatory environment and broaden it out as much as you want.
Sure. So I'll talk about how the change of the administration has affected stablecoin bank partnerships. Then I'll also talk about some really good examples of stablecoin bank partnerships that I've experienced. So in our industry, I think there's 2 types of FOMO. So the stablecoin startups see that this administration might be their chance to apply for a skinny master license. So they have this FOMO that we better apply now, because if the administration changes, they might not have a chance to apply later. And then at the same time, the banks see, oh, there's a risk, or there is already deposits leaving the bank going to stablecoins, so we better issue our stablecoin now. So there's FOMO on both sides. And then I'll talk about some really good examples of stablecoin bank partnerships that I have experienced. So in my previous role, I worked with Cross River Bank, and Cross River offered us on and off ramps. They also began to accept USDC as settlement from their customers. And then now they offer stablecoin orchestration to their own customers. And you might have seen, I think in January, Cross River released a statement saying they support yields for stablecoins. So this is kind of a really unique partnership where I believe that they learned a lot from working with my former company, and then they were able to grow in their understanding of stablecoins, and then now they're a huge proponent of it. Another really good example I have is also in my previous role, we worked with Standard Chartered Bank, which is a GSIB. Their global reach just like help the distribution of our stablecoin, and then I think they also learned a lot from my former company. And then, as you might have heard recently, they received the license to issue the Hong Kong dollar stablecoin. So it's a mutually beneficial relationship. You gain distribution from the banking partner, you gain their credibility because they are a GSIB after all. And then at the same time, they learn, especially their compliance teams and then operations team, learn a lot from your startup as well.
Thank you, Lindsay. Heather, I want to turn to you. I mean, there's some that might say, Didmica or True Lender has no place in stablecoin discussions. I would vehemently disagree, but in your current role going through acquisition or partnership or application where you are now, or in some of the roles that you've worked in the past, I'd love to get also your take from the compliance and risk sense. So same question.
Yeah, absolutely. I mean, obviously, these have been really hot topics for us in the industry for several years. Dimica opt-out and rate expectation, True Lender. I mean, gosh,
I might lose the room. Hold on.
yeah.
Okay.
Sorry, guys.
Okay.
These have definitely been hot topics in the industry for several years. I don't think they're going away anytime soon, and that just adds to the complexity to how these organizations operate. And of course, you're constantly having to explain, how things work and how, you're not running into a true lender situation. And there's also been a ton of litigation around these. So it definitely adds to the complexity of things.
We have till 2:30 or 2:20? 3? Yeah. If I can have until about 6, we can cover everything. We'll keep it going. I'm going to just do a little bit of an interjection from the framing of a question I really liked earlier, and I'll pose to the panel here. And you can take either version of this question of, in 2 years, 3 years, like what would you be most surprised about, or what wouldn't surprise you at all when it comes to where this discussion, where this dialogue, where this shift is heading?
Well, I think there is the timeline is key, 2 years versus 3 years, because you will have an election, a national election in 2 years, in 2028, and that outcome of that election will set policy one way or the other, because you do have a pendulum swinging right now politically that is pretty strong either way. And so, it's always like the inverse reaction of the last reaction. I think industry is hoping less pendulum and right there a little bit more in the middle because of that certainty that's needing. So yes, there is a rush for charters right now because they don't know if that window is going to close in 2 years from now. Or it could could close or it could stay open. And so that's one consideration to have. At the same time, also, is we're seeing an incredible amount of activity in the states that is occurring, and how they're viewing. We're seeing a lot of, as you were saying, a lot of activity around rate importation, who owns the loan, all of that aspect, whether or not you be a national bank or a state bank, because some of the actions that are occurring in states like Colorado or in Oregon, you're starting to see a lot of our members now consider having to go to a national bank partner versus staying with a state chartered bank. And so that change is also something that will, probably continue to have a lasting conversation irrespective of the presidential election. That is occurring now in a divide, and an unfortunate divide between blue states and red states, as to who we partner with because of those issues.
Yeah, so I absolutely agree. And that's definitely what I'm seeing as well. It's interesting because you just, recently saw Cross River Bank, come to Delaware. And the big reason for that was so they could, allow lenders to lend up to 29%, over 29%, sorry. And you're seeing that Column Bank, they're expanding tremendously right now. They're one of the hot FinTech banks that are just exploding with relationships. It was really funny. An investor asked me actually the other day, what do you see as the future of FinTech? Do you think that all the FinTech sponsor banks are going to go away? And I think absolutely not. I just think that the products and services that they offer are just going to change, and it's going to continue to evolve. A lot of the things that you guys were talking about today around stablecoin and crypto, I think that's where a lot of these companies are moving as well. Digital assets.
I have a slightly different answer, and I'll split it into two, like the 2-year horizon and then maybe a slightly longer 4 to 5 year horizon. So for the 2-year horizon, I have very strong views regarding tokenized deposits versus stablecoins. They simply aren't substitutes for each other. Tokenized deposits can't do nearly as much as what stablecoins can do. So I'm hoping that in 2 years, this will be understood. I know that right now there's a lot of banks who want to dip their toes into stablecoins by like detouring into tokenized deposits first and then going into stablecoins. But I hope that they'll probably go through the realization that JP Morgan had. So they also started with tokenized deposits and now have a stablecoin. So hopefully in 2 years, banks will realize that why these are not substitutes of each other. And then in the longer term horizon, 4 or 5 years from now, I hope that banks and stablecoin companies can work together to realize the virtues of programmable money and smart contracts, because I really don't think it can happen with just one working towards it. They really need to be working together. So in 2020, I was working at Libra, right? And then that was the year of the pandemic. And we were talking about, hey, like if we issue like government incentives on the blockchain, like maybe people can scan a QR code after they get their vaccine, and then they get like a voucher automatically dispersed through the blockchain. So that was 6 years ago. And then it doesn't seem like we're going to reach that stage in 2030, like realizing the mass use of the smart contracts and programmable money. But I'm hoping that together, banks and then stablecoin companies working together will make that possible.
Thank you. Thank you, Lindsay. I'm like slowly turning toward the window here. There you go. Let me rejoin the panel. This is all great. And I want to close out the last question for the panel. So please take your time with this, because I think for me, a little bit selfishly, this is kind of one of the most engaging concepts that might get lost in some of these discussions, is that, the impact on the end user or the consumer or the borrower, as the political narratives ramp up about affordability and cash flow management. And I'm going to leave this question purposely broad and take it where you want, but where do you see the biggest benefit for the priorities of either members or the traditional bank partnerships and compliance, or Lindsay and stablecoin? Like, where is the real downstream benefits that you see that's impacting either financial inclusion or cost savings or building trust in such novel products that will drive mainstream adoption? So anywhere you want to take that, I just really would love to get your take and focus on like where you see the end impact in both the positive, beneficial way, or failure to act might prevent adoption, or kind of wherever you can take it. So, and I'll start with you since I haven't started with you yet.
Sure. Yeah. So obviously, with a lot of the regulatory things that have happened over the couple of years and the pressure that has been put on FinTech partner banks and their actual FinTechs to ensure that they are complying with the law and protecting consumers, I think that is just going to continue, which is just a huge benefit to the consumer. I think that's, one of the best things, because I think if you look back probably about 10 years ago or so, you didn't have that. You had a lot of FinTechs that were really running like the wild, wild west. And, unfortunately, a lot of sponsor banks were allowing it, and it did actually harm a lot of customers. I think now that we've had this shift, I think it's actually very positive for society and our consumers.
Thank you. Lindsay, or any?
Sure. So my answer is similar. So in the stablecoin space, it's extremely hard to get banking. That's why I have my job, because it's a very niche area. It's many stablecoin startups, even if they have the licensing, a compliance officer, they won't get a bank sponsor. So in a way, the banking industry is helping mature and filter out the worst actors in the stablecoin. So I would say that's maybe like one of the best consequences of bank stablecoin partnerships. And then for the customer, it's also they're being presented with a wider range of choices, like more products that are brought on by digital asset companies. And then it's more competitively priced and more efficient in serving them. So it's really a really positive thing to have bank stablecoin partnerships. It's good for the industry. It's good for the consumers.
I would say for the end user, the customer, the consumer or the small business, I mean, they've only benefited from the financial technology that is out there in the ecosystem now, the democratization of it, the ability of retail investors to be able to go on an app like a Betterment and be able to watch their 401k and determine and have a different experience. I think the next generation, I don't think any of them are walking into a bank anymore. And so that experience is going to be mobile. You have countries that are all mobile first as far as their banking and financial experiences. And it's allowing for, you know, the new technologies with AI, being able to use it in credit underwriting and have models that are going beyond a 750 FICO score that allows them to qualify for certain type of credit or certain type of mortgages or certain type of car loans and others. All of that innovation, I would say, greatly benefits the consumer. You have it in commercial finance, revenue-based finance. What you're seeing now, you know, with a lot of our members that work with them on their, you know, Stripe, PayPal, a whole host, Chime, others, you know, work with consumers and or small businesses to be able to further enhance their own financial life or their own offering or what they're able to take advantage of. So I think that's only going to occur. And yes, there is a rush to charters, but it is not for the faint of heart. Charters takes a lot, as we have people here working on this, you know, directly. It is not for the faint of heart. It does require a lot of capital. It does require a lot of compliance and risk officers and lawyers and a whole host of infrastructure to be able to handle, to be a federally or state supervised bank or institution. So you will though start seeing in the marketplace, you see it all the time, another earned wage access competitor, or another buy now, pay later competitor, or another revenue-based finance. So the marketplace will continue to iterate. Those that want to become, you know, large will probably have that conversation at one point, whether to stay with a bank FinTech partnership or go to their own chartering. But there's an incredible amount of richness and innovation that is occurring that continues to make the experience of a financial life just that much richer and better.
Thank you. All right, we got 4 minutes left, and I think I've just spent too much time in the policy world to leave everyone with such an upbeat view. So nobody took me up on the question. So maybe we just spend a minute each. I would just love to know, like, what you are worried about. Like, what is the most important trap that you see or worry? And it could be political, regulatory, just in the general narrative. Like, what's keeping you up at night over the next 6 months, and what do we need to do to prepare for it or address it? And Daniel, start with you.
Sure. I just saw Kelvin from Consumer Bankers just leave, so I'll say it while he's out of the room. Open banking. We need to ensure that consumers have the right to permission their data free of a charge.
I would say mine needs big swings. I mean, it's very hard operationally just to manage these big swings with the regulate, you know, and, you know, at the end of the day, like, you know, we just need to protect our consumers and make sure we're delivering products and services in the safest way. And some of these regulatory swings are just, it's so difficult to manage. You know, things unwinding, things ramping up, and then it's just a lot. So that's kind of the big thing that irks me. Really, maybe not keeps me up at night, but definitely is top of mind all the time.
So I was the head of financial partnerships at Circle in 2023. So you can imagine my life was very difficult. in March when Silvergate, Signature, and Silicon Valley Bank were collapsing. And then FTX a few months before that didn't make it easier. So I'm always afraid that something similar might happen again. So that's why I'm very keen to have redundancies in our bank partnerships. And then to always like check in with the bank to make sure that they're happy with the partnership. And to always kind of stay one step ahead of the requirements that the bank might ask of us. So yes, like I think of, the possibility that this might happen again.
Okay, with that, thank you, Jalapa and here at University of Delaware for having me, and thank you to the panelists for this discussion. Thank you all for sticking through the day and for listening. So we'll close out. Thank you.